Global market volatility has surged sharply higher since July 28th. Iran and their proxies picked a bigger fight, unexpectedly firing at the major U.S. Middle Eastern staging base in Jordan and at an LNG export terminal in the Mediterranean Sea just off the Egyptian coast, signaling a further escalation of the Iranian conflict. The U.S. responded in kind, which created turmoil in the oil and financial markets. Meanwhile, the Fed held the Fed fund rate steady at their just concluded July meeting, but U.S. equity markets, the Treasury markets, and the currency markets were anything but steady. What remained steady through all this turmoil? Gold, which probed higher. In this gold market commentary, recorded on Sunday, August 2nd, I'll explain how markets around the globe are becoming increasingly sensitive and potentially more fragile to adverse events going on in the now expanding war against Iran and the restricted flow of oil out of the Persian Gulf. I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas. Let's get on with our update. This is a map of the Persian Gulf region that shows all of the major attacks from the US and Iran since July 7th. And you can see that's been quite active. But what is new is what's been happening down in Yemen, around the Bab al-Mandeb Strait, and especially in that little red circle up to the upper left in the Mediterranean Sea. That's the LNG export terminal that Iranian proxies in northern Iraq took shots at on last Tuesday, which set the gold price up $100 and put the oil price up and put equities markets into a bit of a tailspin. So this is a sign that the conflict is expanding. Saudi Arabia now wants to put a coalition together to fight against the Houthis in Yemen. What many of you may not remember is last April and May in 2025, the U.S. had about a 45-day air campaign against the Houthis in Yemen for the very same reason. They were raising trouble in the Red Sea at that point in time, and we helped Saudi Arabia out then. And now they're back at it. So Iran is using their proxies in Yemen and in northern Iraq to expand this conflict, picking a bigger fight. And now we're taking the fight back at them. Saudi Arabia wants to put a coalition together to protect the Red Sea shipping, which means this conflict is spreading to other nations in the region who've tried to remain as neutral as possible throughout the conflict. It's getting bigger, wider. This is not a good sign. And what's happening? Well, the oil price is responding. This is a chart of Brent crude going back to January 1st. You can see the major volatility that we've seen in the oil price for Brent crude and WTIC out of the US. We peaked at $100.69 per barrel after the U.S. completed their 13-day bombing campaign, and we paused, and now we're punching back up again a bit from about $84 a barrel to a little over $90 a barrel with the renewed fighting that's occurred over this past 3 or 4 days. Now, I've watched and listened as President Trump has repeatedly come out to talk about how we're entering into negotiations, or a truce is at hand, or we're working on the memorandum of understanding, jawboning the markets lower for oil in particular. But I heard an interview with Jim Bianco this past week, who's a brilliant analyst, who said quite succinctly, every time oil goes over $100 a barrel, President Trump does something to bring it back down. He tries to talk it down, or negotiations start, whatever. So I said, well, let's put this to the test and see. So this is the same chart with all of the military activity labeled. Everything in red is aggression, and everything in green is a lack of aggression or a cease of aggression. And you can see Jim's right. It's like President Trump has a trigger at $100 per barrel. And this is a very disturbing sign. You cannot prosecute a war properly to its final conclusion that you desire if you're beholden to financial or commodity markets, which is what President Trump has been trying to do. Talk the market back down when the market went adversely against him or against us. And as I said in our last video, this is the point in the phase with restricted oil out of the Persian Gulf where a lack of continued supplies could really start to affect the available supplies sharply. This is where all the analysts said the point in time is in August, where we'll start to hit the bottom of the storage tanks that we do have available after we've used up the available shock absorber that was available in the marketplace. And we're seeing that in the spreads between the price of oil and the refined products, diesel, jet fuel, and gasoline. In January, the spread between the price of a barrel of oil at about 60 and diesel, jet fuel, and gasoline was about $30 per barrel at $90 per barrel for all three of those, give or take a couple bucks. Now the spreads are sharply higher. The spread between the price of oil and gasoline is about $50 per barrel. And for diesel and jet fuel, it's $80 a barrel, or almost double. And this goes back to July 17th when the oil price was still coming down. I don't have the latest figures for the last week or two here. And this doesn't really take into consideration what's happened in Russia fully yet, with Ukraine hitting Russian oil refineries. Russia has been an exporter of refined products, diesel, jet fuel, gasoline. Now they may become an importer, which could further strain the situation. And what's also happened throughout this entire crisis is China has been reducing their oil imports sharply to help ease the strain in the markets. But now they may be re-importing oil again. And as I said a month or two ago, when China makes that turn, it could really put some more upward pressure on the price of oil. So let's see how this all translates. But this is where the rubber meets the road. And this is not a good sign right now. It could get worse, and potentially a lot worse. We're also seeing turmoil in the financial markets, the equities markets. The Kospi, the semiconductor index in South Korea, literally puked this week, dropping from about 67.55 on Tuesday all the way to 52.90 on Thursday, about a 23% drop. Now, this has been a market that's been doing nothing but going hockey stick higher with leveraged retail buying. And a lot of people got stopped out this past week, including Leopold Aschenbrenner, whose hedge fund was heavily invested, leveraged again 4-1 in a couple of high-tech Korean stocks, got stopped out and sold to Ken Griffey's Citadel at a discount price this week. A young investor leveraging up, looking like boy genius, got a real big market lesson this week.
Get weekly institutional-grade metals analysis for just $19.97 per month. Donna Samuelson, 46-year gold market veteran and protege of the man who re-legalized private gold ownership in America, just launched a new Substack that helps you stay informed about what's really moving gold and silver. No hype, no price target theatrics, just the clearest read on the metals markets in a format that actually fits your day. Visit news@amerigold.com and subscribe to get this week's full breakdown.